We're going to go through Netflix earnings. If you're watching with us live, good morning. If you're watching the recording, it's great to see you. And yeah, I spent several hours last night going through Netflix earnings. I also had the chat up, so I would love to hear your guys' interactions. Again, normally I'm used to talking to Daniel here, but it's just us today. So if you're not aware of Netflix, you might have been living under a rock, but Netflix is a streaming company. They have a lot of first mover advantages and they're very well known. So people stream videos from them. And a lot of the headlines coming out are Netflix drops on earnings. So just one quick note on that. Whenever you see news in the headlines, people say this stock dropped or this stock, raised up. You have to go back in history. So sure, the stock did drop on earnings relative to what it was trading at the day before. However, the stock is still up on the month. So that's an important thing to note. A lot of stocks will run into earnings. You'll hear people say, buy the rumor, sell the news, what have you. So what we'll be doing here today is going deep through their earnings reports and really seeing if we think that this stock is a buy or not. Just know that this is not financial advice. I'm not a financial advisor, neither is Daniel. And we do not do enough research on this show to do a buy or sell. This is purely stock nerds just talking about stocks. And again, not financial advice. So SEC, if you are watching, do not come after us. We are not financial advisors. So I thought it'd be fun. I actually found a program where I can draw all over the earnings notes here. And I'm going to check the chat quick before we start. Good morning, Milen. Good morning, Alex Pohl. Yes, you did make it to the beginning. And yes, if you are playing the drinking game where you take a sip of, we'll call it water, whenever we have an SEC disclaimer, definitely take a sip. KR, hello from Germany. Sangita, Cheer Up AI. I recognize that name from the Discord. Andrew, Nathan, what is up? Yeah, I appreciate the cheering. I don't know if you can tell. I'm a little nervous without Daniel, but we're going to make it happen. We're going to do it live. The worst thing that happens is everything falls apart and my apartment lights on fire, but well, we'll see how that goes. Anyways, what we're looking at here is the earnings presentation that Netflix puts out to its shareholders. You can find these from the company's investor relations website. My plan here is I'm going to quickly go through this report. I already highlighted it and went through it last night. So there's a few things I want to call out. Then we're also going to go over to Stock Unlock, check out their valuation, and look at some bull and bear theses here. And with the chat, try to figure out how we feel about this. And I'm expecting there to be some mixed opinions. So right off the bat, 5.9 million subscriber ads. This is great. A lot of us know that they introduced their ad-supported tier. This is a lower price tier where people are able to pay less but get ads. This is also combined with them doing a lot of password sharing crackdown, which for anyone that's following this stock knows, Netflix did a huge initiative to crack down on password sharing. The reason for that, obviously, they want to get more money. If there's 5 different families all sharing the same password, they should all probably be paying for the service. They also saw revenue go up. They are reporting that they're expecting revenue to accelerate. A few things in this report that I found interesting is they are reporting future higher cash flows due to higher signups, but also the strike that's happening in Hollywood. They think that they're going to be spending less on content since they literally can't. And we're going to be talking about that too. So anyways, let's just look quickly at their numbers here. They are forecasting 8.5 billion. That is up from 8.1 billion reported this quarter. That is going to be a big revenue high for them. So people are excited about that. That would be a 7.5% growth. I also wanted to call out that their forecast for their for their net income rather, is actually flat or relatively flat. 9.6% isn't flat, but it is really not moving up that much if you look over the 5-quarter span, just going off their forecast. And of course, pretty much relatively flat, just up a few percentage points if you look at what they reported today. So that is one of the themes I saw in this earnings report. Their numbers are still matching what they did 4 quarters ago. And I think a lot of people are forgetting that when you compare it quarter over quarter, they actually did not do super, super well the last couple of quarters for a growth company, just in my personal opinion. Now, you will not see this in the regular earnings presentation. I could probably share this document if people want a copy of it, but I started running some numbers actually using some AI programs to help me analyze this. I saw that the revenue per paid subscriber and net income per paid subscriber is actually going down. So here on the right, Q2 2022, the revenue and net income per subscriber, you can see it right here, 36 and change, 650. On the left, 34 and change, and 624 for the net income. So the amount of dollars that this company is bringing in is going down per subscriber, which could potentially hit at a lack of moat. One thing that a lot of the bulls of this company are talking about, even though, again, relatively the stock did drop on earnings, even though it's flat over the month, they do see revenue growth expanding. They're aiming to grow their positive free cash flow. My thoughts on this, blah, 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 management. Of course, you're trying to grow your top line, right? Like, let's see the proof in the pudding here. They're also telling us, they expect that the net ads are going to be similar to the Q23 net ads. So they're adding the same number of people coming in. This is actually, depending on how you look at it, a good or bad thing. Some people say it's good. They're still signing people up. Other people say it's bad because this company is priced as a growth company. And it is kind of interesting to see that their growth is not accelerating, even though, as we're going to see later, they are still being valued like a growth company. You can see, if you see any X's on this, if we talked about everything in this entire earnings presentation, we'd be here all day. This is one of the disclaimers I give that we're not doing enough research to make an investment, but I did put some X's on some sections to remind myself to the chat, hey, Jake, you shouldn't endlessly talk about this because, time is a thing. Here's what I found incredibly interesting. This is actually very bullish for management. Right now, the way that Netflix makes money is from their streaming revenue. People pay a service fee that varies per country, and then Netflix obviously gets the money from that subscription. It is predictable revenue. Warren Buffett actually says that he likes subscription businesses. He was not talking about streaming, to be clear. And no, Warren Buffett does not buy companies like this. But Warren Buffett does like insurance companies because there's premiums, insurance, pretty much sustainable revenue on a subscription basis that comes in over and over again. So again, I'm just representing some of the bulls. Not that I am myself one in this stock, but the bulls say that that is a good thing. Management is saying that they could potentially have a multi-billion-dollar revenue stream on ads. So that is what I highlighted here. This is something to watch very closely. We have not seen them report tons of revenue yet from ads, but I will be watching this closely. I am not a shareholder here, but since I study the reports, I'm very curious to see if they will actually make that a multi-billion-dollar revenue stream, because that will start to become a very material part of their business. This is one of my biggest issues with Netflix. So the competition. There is a question among investors of what moat Netflix has. Some people say that they have a moat with first mover advantages coming to the stock. Other people say that they do not have a moat because anyone can kind of just create streaming content. And they do touch on that here. And they actually say it a lot more verbosely than I would have expected them to. They specifically call out other companies' names like Apple, and that their big competitors such as Apple, Amazon, and YouTube all have deep pockets. So Netflix is going up against some really, really, really big industry players. And as we saw above, their revenue and net income per user is going down. So you have to start asking yourself, what moat do they have? What pricing power do they have? Is this a race to the bottom? And is Netflix going to be continue to profit as a company where their pure service is streaming, when a couple of their competitors like Apple, Disney, YouTube, Prime Video, Peacock, these are all companies that are very multifaceted. Streaming is just one of their segments. So they're able to take profits from other segments of their business and put it into streaming. Netflix right now doesn't have that. They're trying to do that with their advertising business. We'll see how it works out. I'm catching up with the chat really quickly here. Good morning from the East Coast. What's up, Knockabout? Dave, what's up, guys? Don't be nervous. Just hang in. Yes, just a single stock nerd this time talking about stocks. I do miss Daniel, I'll be honest. Daniel, if you're checking it on your phone or if you're listening to the recording, it's not the same without you, but we're making it through. Andrew Blunt, Jake, I'm drinking again. I'm assuming you are talking about coffee there. Cheers to that. One thing I learned about doing a stream solo, I don't have time to drink my coffee because whenever I'm drinking my coffee, I can't talk. David comes in. There are like 12 streaming services on my Roku TV, all doing the same thing. Yep. And this is what you're seeing in this graph right here. There's a lot of players. And yes, Netflix does have a lot of market share. They are doing well. It is a big question mark to see if they're going to be able to carry this performance into the future. So let's keep on scrolling through here. This was a very interesting slide to me. So they are anticipating at least $5 billion free cash flow up to 2023. This is going to come into play when we do a discounted cash flow analysis in a little bit. And they bumped that up from their estimate. So I actually thought that investors would be a little bit more bullish on this because they are citing, if you can see here, the WGA, SAG, AFTRA strikes in green on that last line. That is a Hollywood strikes around all the AI stuff. That's a whole nother topic we won't get into, but it is important if you're thinking about investing or looking at Netflix stock, that there is going to be some type of effect on their business, whether that's from content creation and or them saving money since they actually can't spend on that content, it is then up to you to decide if that is actually a good or a bad thing. They do have debt, so I wanted to call that out. This company has $14.5 billion in debt. They have $8.6 billion in cash. They are generating cash, so I don't think this debt load is a massive concern. It's not great because, of course, they will have to service that debt eventually, but it is important to note that this company is dealing with some debt. That being said, though, they are actually doing some share repurchase activity. So they repurchased 1.8 million of shares for 645 million, and they have 3.4 billion of capacity remaining on the 5 billion share buyback authorization. So that is exciting. You have to ask yourself, when the company has debt, they have some positive cash flows and things like that. Should they be buying back shares? Should they be paying off that debt? This is a kind of opinionated question, so I'll just float that out there. Leave your opinions in the chat, what you think about this behavior from companies. Do you like that Netflix is repurchasing shares before paying back the debt? As a shareholder, how does that make you feel? Or if you don't hold the shares like me, how does that make you feel? We're going to skip over the ESG stuff. Let's see. Is the t-shirt available for purchase? No, dang, the t-shirt is not available for purchase. One thing we don't have time to go through here, if you were to think about investing in Netflix stock, I highly recommend looking at their regional breakdown. Just a little bit too much data here for us to pick apart, or else we'd be here all day. Same with the FX impact, just foreign currencies and things like that. All right, now we're looking at the consolidated financial statements. So we went through their earnings slides pretty quick. This is one thing I wanted to call out, and this is what you won't hear the company talk about. When you go through the company's earning presentation slides, you need to understand their narrative. As the executives of a publicly traded corporation, their duty is to give as much value to shareholders as possible. That is usually done through share appreciation and people wanting to buy the stock. How do you get people to buy your stock? You make them think it's a good stock. How do you do that? You put together earnings presentations that make things look all fluffy. You talk about all the subscribers you made. You talk about your share repurchases, all that kind of stuff. And when you give a slide about your competitors, you put yourself at the top. What they don't show you is what we're about to go through here, which is their more raw financials. They can't lie about these. So what they didn't tell you in that report is their marketing spend is up, which I found interesting. So while they're making more revenue, they are raising their cost of marketing. You might also notice that their operating income is going up. So why is it still going up when they're spending more and more on marketing? I actually found it interesting that their technology and development is down. So something to note, they're obviously still spending a lot on it, but they are spending less innovating. So when I look at companies that are competing with them like Google, Amazon, are those companies spending less developing? And you have to ask yourself, in 5 or 10 years, are they still building to be the leader? I don't know. I honestly can't tell that from these numbers, but I think they're fair questions to ask. And yeah, this is what I talked about before, only 3.3% profit growth on the year. Don't really love that. When you look at their year over year numbers, things are relatively flat. So that is something to keep in mind. This is their cash and cash equivalents, which they called out above. I, again, wanted to highlight their debt here. So when you're looking at the balance sheet, just make sure you're understanding how their assets stack up to their liabilities. I didn't see any huge red flags here. They're one of those companies, which is pretty popular. They do the financial magic where they have all the numbers just match perfectly. As you can see here, this number of total assets perfectly matches the total liabilities. And at least for me as an investor, it makes me really question, is everything like that to the dollar, or are they doing a little bit of financial magic there? And yes, this is the last statement we'll be looking on at these slides. One thing that I did think was good is the net cash provided by operating activities is going way up. This is cash that the company can use to invest, or rather pay off debt, buy back shares, things like that, which the company is starting to do. So that is a good thing. You want to see operating income go up? That's good. I also want to call out, too, that they are repurchasing stock, also issuing stock. I thought that was a little bit interesting. A lot of these are likely from employee options and things like that, stock-based compensation, as we like to say here. And for those of you who aren't aware yet, we did add stock-based compensation as a line item in Stock Unlock. This last item here, which again is a good thing, their cash position is going up. So they are getting more cash over time. All right, I'm going to pop back into the chat for a second, see what you guys think about that. We can go on to talk about a bull and bear case here and see what their value is, but want to gut check with the chat how we're feeling. Another topic here to talk about is AT&T. Hi from Malaysia again. Wow. It is crazy that we have global viewers. It's probably not the morning there, though, eh? Good catch on the accounting magic, Jake. No problem. I'm sure if Daniel was here, he would be finding cool things too. So he will be with us next week. If anyone is joining and wondering where Daniel is, he is traveling for a wedding right now. This is not normal. If you watch our last episode, I was actually at Daniel's place in person, which was really incredible. We get along very well. Someone asked, hey, are you guys going to get along? Just so you know, that was not the first time we've met in person. We've been meeting up in person for a bit now. And yes, of course, we are friends. Hi from Canada. What is up, Captain Strange? Yes, great to see everyone. If you are listening to the recording, come hang out with us live on YouTube sometime. Anyways, I am leaving the chat. I still got you guys up on my phone over here. But we're going to keep on talking about Netflix. We just went through the whole report. And I think that it's only fair if we do a bull and bear argument here. So we kind of went through a lot of these. What's the bull case? They have strong brand IP. They can produce evergreen content. Selling ads is a new revenue stream. And as we saw, the company expects that to be a multi-billion dollar revenue stream in the future. AI, will it help them? Will it not? Well, the bull case side of AI is going to enable faster content creation at a lower cost. And based on Netflix's existing distribution and brand power, they are going to be able to leverage that, lower their cost substantially, and produce even more content. This would be great for a lot of reasons for Netflix. They obviously would have higher and higher margins, and they would be spending less. Obviously, that is indirectly related to the higher margins. First mover advantages, Netflix and chill. Everyone knows that. We did not go through the engagement section of their shareholders letter, so I actually suggest you do that on your own time. It's pretty interesting, but they have impressive stats on how engaged their existing viewers are. The Hollywood strike might help them save money. Just quoting their investor presentations here again. Excuse me, folks. And yeah, during the quarter, they started repurchasing shares. So at a base level, repurchasing shares, usually a good thing. You want to make sure that they're using the money responsibly. And for the bear case, just a pure disclaimer here, I tend to be pretty bearish on Netflix stock. And I'm doing my best right now to put on a face to play both sides. But I want to, if it's not obvious, I want to keep it 100 with the chat and live viewers here. So let me know your opinions about Netflix stock. I'm going to go through a little bear case, and then we'll hit the discounted cash flow calculator, which is a really fun way to try to figure out the value of the stock today and if it is a buy or a sell based on some mathematical parameters we type in. That'll be coming up in about 2 minutes for you folks. If you look at their trailing 12-month operating cash flow figures, I pulled these and added them up from their report. Currently, the stock is trading at a 190 billion market cap. Roughly, we can see that right here in Stock Unlock. So going back to our handy dandy notes here, you could see that the free cash flow yield is just 2.24%, trading at 44.6, and the operating cash flow is not too far behind. A little bit pricey, but it has been more expensive. Their yields and things have been pulled a bit in the right direction because, of course, they have been reporting higher operating cash flow and free cash flow figures, which, again, they did say in the report, they are expecting to do $5 billion in free cash flow next year for the full year. That's a big deal. Paid, so this is continuing the bear case. Paid signs, instead of being a good thing, is actually a sign of things yet to come. Lack of moat, lack of pricing power. And as we saw, their dollar amount per subscriber based on a revenue and net income are both going down. So that is not good. Here's the other side of the AI argument. I wanted to bold these because there's two sides to every story. And as an investor, we should all be trying to look at what our first opinion is, but also try to look at people who disagree with us and at least be able to stand in their shoes. So above, we looked at how AI will help. Here, we're going to say AI might hurt because from the Incredibles movie, we know once everyone is super, no one is. And once everyone has AI and once everyone can produce this content at a low cost and potentially even have easy distribution through AI as well, does this continue to attack their moat? We're going to have to see that play out. In my opinion, yes, but I could be wrong. Also, just an opinion, I am not a huge fan of a society that just sits down and watches TV all day. I'm not telling you that you shouldn't live your own life, but I think that there's a difference between watching TV for 10 hours a day and 1 or 2 hours. That's just me. And when I use my money to invest in a stock, I want to invest in things I support. So I'm not sure if I want to support a company where their pure mission is to increase the number of hours each one of their subscribers is spending sitting down watching TV. And sure, the Hollywood strike, it could be a good thing. Here's the two sides of the story we keep talking about. The negative side of this is that it'll hinder their ability to make unique IP, and people tend to come to Netflix for their unique shows and launches. So we don't know yet how much this will affect their ability to launch new shows, but we could be seeing a slowdown in the amount of output they have, depending on how the strike goes. Also, this is probably one of my favorite parts. We're going to open up the discounted cash flow calculator tool here. So what we're looking at here is a mathematical model. It is a lot harder than it sounds. And if you're new to this, we have question marks that define everything. So don't be scared. We even break down the calculation. However, I will be running through it a little bit quickly here on the stream since many of us are already familiar with this. So let's remember that, management said that they believe that they were going to bring free cash flow to $5 billion in next year for full year. So let's make sure that we're projecting on free cash flow. Let's get the metric growth rate. Let's just say 10% and see where that lands us. 4.72. All right, let's pump this up a little bit. Let's be generous and say that they can grow their current free cash flow at a rate of around 14%. This will put them at $5.65 billion in 2028. So this is actually way less than the company is predicting they will make. And right now, the price ratio they're trading at for free cash flow, as we saw from our notes before, was actually 44.6. This is based on their latest report. Again, that number comes from right up here. So we're going to start to see some output here. Right now, what this mathematical model is saying is if we project their free cash flow out 5 years to 2028, and their free cash flow grows to $5.65 billion, if we want to get a 10% return on the stock, and we're going to assume that it's still trading at a 44.6 price to earnings ratio with very little share growth. This is actually in line with their averages. We see that the future stock price would be $566. Not bad, but the fair value today, if you wanted to get a return of 10% compound annual growth rate per year, discount rate, it's one of the hardest things to understand, then you would have to buy it at $351. So based on these assumptions, if they trade at this ratio, grow at this rate, and trade out 5 years, you will have compound annual growth rates of 5.78%. So this is making a lot of assumptions, but I want to hear your opinion in the chat. Do you think Netflix can get this growth? We'll even pump it up a bit. Let's say that they'll do 20% growth and that their free cash flow will be $7.3 billion. This is more in line with management's expectations. You actually get that the fair value today is $454, which is below today's stock price. I personally don't believe that they're going to do this, but with their revenue stream coming in, I have to be fair and say it seems like a possibility that Netflix can achieve these numbers. If they continue to have first mover advantage, leveraging their strong brand, getting more money from advertisements, getting more people to sign up since they crack down on password sharing, and they do better than their competitors, the stock may be trading at a fair value today.